Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I want to talk about the ECB Forum on central banking. This is an annual meeting organized by the ECB in Sintra, Portugal, and it's meant to bring together central bankers, academics, market reps and others to exchange views on policy issues. Now, before we get to what the major central bankers themselves had to say, I would point out that at this forum, the ECB does award a Young Economist Prize to PhD students and offers them an opportunity to present their work. Now, this year's prize was won by Federico Cochin of New York University, who demonstrated that losses to firms from higher financial frictions can actually be quite sizable. They tend to be higher for younger firms in middle-income countries relative to larger firms in higher-income countries, and can contribute to more young firms exiting the marketplace prematurely. So certainly something to think about for relatively new firms. Now, coming back to the key central bankers themselves, Fed Chair Powell, ECB President Lagarde and Bank of England Governor Bailey all took to the stage yesterday, and several comments from them stood out in our view. Fed Chair Powell said that the process of bringing down high inflation was, quote, highly likely to involve some pain, but argued that that was the lesser of the two evils compared with allowing high inflation to become persistent. Powell also noted that while there was a narrow path to achieve a soft landing, capping inflation without pushing the economy into recession, he still argued that the risk of tightening policy too far was not the biggest risk to the economy compared with failing to restore price stability. Now, ECB President Lagarde said that the era of low inflation is unlikely to return and that central banks had to adjust to significantly higher inflation expectations. She also added that the forces unleashed as a result of the pandemic and geopolitical shocks would have long-lasting effects. Firms picking a manufacturing base, for example, may start to factor in additional factors other than just cost, including whether the location was politically friendly, for example. She also added that the Ukraine war was hitting Europe harder than most other regions, and hence the region was not in quite the same situation as the US. So overall, the central bankers were at pains to re-emphasize their commitment to fighting inflation and add color around the risks this could bring. Now, what conclusions can we draw as investors? There are several that jump out following these comments, but today I'll focus on just two. The first is that Fed Chair Powell's comments in particular fit well into our own second half view that this is a good time to add to income assets and take advantage of higher yields on offer. While the risk of further adjustment of rate expectations is not off the table, the fact that a considerable hiking cycle is already in the price means bond yields are now sensitive to the downside as growth risks come to the fore. The US 10-year government bond yield, for example, fell around 7 basis points yesterday after his comments at the ECB Forum. This means that we see an opportunity not only to add to multi-asset income strategies, where yields are pushing on 6% on our model, but also to rebalance towards bonds from equities within more balanced allocations. That's, of course, a more long-term conclusion. The second, of course, a bit more short-term in FX markets. Now, the US dollar rebounded yesterday after the ECB Forum comments yesterday, and while it remains a little bit away from recent highs, for the euro-dollar pair in particular, we continue to believe a retest of key support at 1.034 is probable, given what were still hawkish comments by Fed Chair Powell relative to ECB expectations that are not shifting significantly higher quite yet. Now, looking ahead, the US PCE inflation data release is the next key threshold, which markets are likely to be quite focused on, and that's due later today, US time. Beyond that, of course, Steve will be back tomorrow with the Through the Noise podcast to place all of this in context. But while you wait, please don't miss the mini-series on our second half 2022 outlook, which is also being made available each day with a new podcast on this channel. So we'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.